everybody. This is the Beats Roundtable. I am Herb Greenberg. It is Tuesday, August 13th. As always, our group is here to talk investment ideas, the markets, and whatever else they are buying, selling, even shorting. With us today, Mr. Paul Meeks, Robert Marson, Russell Young, Jeff Mackey, possibly Charlie Peabody, Steve Lamar over there in the corner to keep us honest. All right, Jeffrey, this is your day, Consumer Day.
It's Consumer Week. We're all excited. Who's not excited? I mean, it's what better replacement for the Olympics than Walmart and Home Depot reporting. The big news of the day, obviously, this morning, and I'm sure for the rest of the day, Starbucks, record day, best day in the history of Starbucks, giving the axe to the CEO who Berna has discussed quite colorfully. Wall Street was not a huge fan of his strategic initiatives or just general mojo or kind of feeling for the stock. They bring in the Chipotle guy. Chipotle's down something 15%. Starbucks up 20% and higher for the year. It's never the news, really. It's the reaction. This kind of gives Starbucks essentially a pass. You bring in a widely respected brand new CEO. From my perspective, that's kind of a double shot of you better not be short this thing. And that's kind of what we're seeing on the street right now. We've talked last week, actually, about, or 2 weeks ago, geez, time flies. You know, remember when the market was crashing and we were in a recession? It was the beginning of August. We talked about how we saw some stickiness in some of those beaten down stocks. McDonald's, Starbucks, and Nike were the ones I mentioned here. And, you know, they were coiled springs, apparently. Nike's actually higher today just on the idea that maybe Brian Niccol will come there and be CEO as well. I guess. I don't know, but it's when you get these kind of beleaguered CEOs, it's not that he can fix the economy. It's not that he can necessarily kind of fix what's going on at Starbucks. He can undumb it. And that makes it really hard to short. This buys him a couple quarters with the amount of juice that he brings in from Chipotle to come out and say whatever he wants. He can clear the deck in terms of initiatives, in terms of earnings. He's not going to be beholden to estimates, and this just creates a whipsaw effect. And so I think you have a combination of people just wanting to get on board this Starbucks trade. And at Chipotle, it was up 800-some%. Starbucks mentioned that in their press release, where incidentally Howard Schultz also came out at the end and said he applauds this move and what a great credit this is, which is just his way of kind of Nancy Pelosiing the ouster of the old CEO. But, you know, it's I think your takeaway here is the reaction. Home Depot also flat to higher today, despite the fact that they themselves said the back half of the year is going to be terrible. So you're at this interesting point in the consumer stocks where the results aren't terrific, particularly in these old guard names. We're looking straight into kind of a weaker economy. Home Depot themselves kind of was like, you know, you probably don't want to buy our stock. People bought it anyway. And that just shows it's really late in the game to be short these things. And on the long side, you know, you're not going to get 22% pops in a lot of things, but it's not a coincidence that Nike's higher today, despite the fact that, you know, Home Depot is saying no one's buying housing, and that doesn't mean they're running out to buy shoes. It just means that the consumer, again, is showing signs of weakness. You know, we're out to a great start on Consumer Olympics week. I don't think Walmart's going to be great. I think it's going to kind of smack of a lot of what Home Depot said in terms of the back half not looking terrific. But at this point, these companies that are so big that they effectively are the economy, you know, they're not going down on bad news. I don't know what that means for Walmart as a trade, but it definitely means, you know, it's not time to be out there gunning against these slow growth, boring names, not with, you know, the anticipated Fed moves, I guess, and just general kind of Home Depot's been flat for 3-4 years. So at this point, just not going bankrupt is kind of a victory for them, at least on a moral basis. And as far as with the stock doing.
Hey, Meeks, question?
I'd like to ask a question of the third rail of consumer coverage, Jeff Mackey. I'm going to give all you guys nicknames, matter of time. Jeff, so CMG, I think it had a kind of a controversial quarter. Stock, including today's battering, is down about 30% from the high. Was this guy Brian Niccol the entire company, or is this a buying opportunity in Chipotle because the company still can flourish without him?
You know, Brian's really good, and I friends of friends with him who went to school with him. You know, I've kind of been on that train just on the virtue of the fact that he's really good. He did not, in fact, invent the burrito. But what he was really good at is things like, you know, he controlled controversy. And that's another thing that weighs in his favor at Starbucks. You had the portion control issues going on. You had a lot of kind of that fermenting sort of, we're going to be all mad at Chipotle. He squashed that really well. He's an exceptional CEO. Was he this good? I'm not so sure, but that Chipotle was kind of rolling over already before Brian left, and this just accelerates the move. He didn't exactly take his time getting out of there. Laxman is gone as of right this second at Starbucks, which means that Brian's coming in pretty fast. So 2 weeks notice amounted to kind of this morning notice, I suspect. And it's you don't like to see that in the company, particularly with the stock already rolling over. And as you said, how was the quarter last time? Well, it was okay. They're another kind of growthy company that came out and said, all things being equal, the consumer is spending just a little bit less. So you don't get rich buying stocks up 22% the way Starbucks is, or kind of shorting stocks down 14%. But we've got a little bit of a falling guac situation going on at Chipotle, and I think there's just plays out there.
Yeah, Russell.
Yeah, Jeff, when we think back to when Nichols came into Chipotle, the problems were evident and they were easily fixable. Is the same true for Starbucks?
When he came in, remember, I will never forget, especially because I was long calls when it happened, the quarter where Chipotle literally had mice falling out of the ceiling, and I think it was Dallas. That was the nadir of Chipotle, as it would be for most restaurant chains. It's those problems were fixable. He can just be less dumb than what was going on at Starbucks. Starbucks was kind of what happens when you hire a consultant to run things. We came in with just a whole bunch of anagrams and Project Heat and Project Steam and Project this and that. His deliverables were clear as mud. It's one thing to present that stuff to a boardroom when you're trying to get McKinsey style fees. It's another thing to say to Wall Street that, our internal metrics are great. There's stuff you can actually see in our report sucks, but if it's inside, we're really achieving these internal metrics and goals and room for serving. There's tons of low-hanging fruit there. And, Berna can speak to it as well, but there were questions in terms of Starbucks real estate strategy, in terms of just them playing Me Too with the bros of the world. They really have just been kind of behind the trend for years. And in fact, this is a great time for Brian to be coming in, because a lot of the wet work's been done. Starbucks, the truth is, they did need to redo the chain. Their flow is not right. Their locations are not made for what we have today in terms of the consumer. They were built at a time where Howard Schultz's original vision was that people would hang out at a Starbucks. No one's hanging out at a Starbucks anymore. They don't want you to hang out. Please leave is the unofficial motto of the place. But right now, fix the app. If you walk into a Starbucks, it's almost impossible to pay. That would be one thing he can fix right away. So yeah, there's plenty of low-hanging fruit there. And again, he can fix it, and he can take a quarter to do it, and he can take charges to do it, and that just makes it a super toxic short. I'm not sure that the earnings explode off this, but he doesn't care about that for another 3 or 4 quarters. In 16 months, it'll start counting for him in terms of operational performance, but who knows where the stock's going to be by then.
Well, Jeff, they're going against a ton more competition. Here in San Diego, there's a Starbucks. There's an amazing Starbucks. People aren't hanging out there. They're going around the corner and they're hanging out at a place called Phil's, and they're hanging out a bunch of other places. But here's the interesting question, I have, and that is, we look at a guy like Brian Niccol coming in. He's got a great reputation. He gets very high scores from Management Track, which does due diligence of CEOs. But, we could have said the same thing about Mary Dillon and Foot Locker. Is there a chance that he doesn't have the magic here, the same magic?
Absolutely, baby. It's of course there is. Nothing is guaranteed to anyone. But again, that doesn't matter for another 16 months. So for sure, is he going to fix the economy? He didn't invent the burrito. He's not going to invent a new style of coffee. But he can make things operate more smoothly. He can take the best of the past initiatives, which involve updating the entire way that you flow on your Starbucks. They involve when you place an order, something like 20% of the orders that people place in the app never get filled, which is just an unbelievable disaster. He can improve all of that. And I fully expect him to be able to do that. That's just a matter of grading it properly and executing. He's not magic, but he's better than what they've had. This is the third CEO they've had in as many years. I think they gave Laxman 1 year to turn this around, which is kind of lunacy. And Brian had something like $70 million worth of Chipotle stock, which Starbucks is going to have to pick up for. So that would be a super expensive 1 year hire at CEO. So I think what people are buying are a stability and the idea of just basic competence and an understanding of serving things that you drink or eat to other human beings.
Thanks, Jeff. Of course, I'm wondering who someone had something to say.
Last thing, I agree with everything you're saying. I think with this move, though, I think we're putting way too much emphasis on them. And I think Starbucks, I don't think the stock's going to go up much from here. I shorted a little bit.
I don't think I would buy it up 25%. I wouldn't buy anything 25%. You want to buy something off this, buy Nike, because if you're bored right now, it's like, and you're beleaguered, as they say, and you have activists out there. Boy, this looks like a quick fix. I saw the chairperson of Starbucks on CNBC this morning kind of acting like Howard Schultz himself didn't rise from the grave yet again and put the axe in Laxman's back, which is completely what happened. But this is a quick fix. And for want of a better idea, again, Nike springs to mind, but there are other companies that if they've been struggling for a while, if you're the board there, this is a quick hire and quick fix.
You keep talking about Nike, and you're the guy who wants. I'm just reading between the lines here and what you're saying on Nike, Jeff. And so I suspect I'm reading between the lines. Huh?
What's that? That I'm going to get hired at Nike? I'll let you guys know first.
Okay. Sticking with the theme here, Sweet Green has been one of yours, and it's been one of yours that you're continuing to be positive on this. What makes this one so special?
Well, I think other people have talked about it on the show, and I was just remarking that last week they put up a really impressive quarter. And this time when everyone's talking about weak consumer and we're seeing companies like Starbucks really screw it up, Sweet Greens put up a 9% comp, which is the best we've seen in a long time, maybe the best ever. Price, mix, and volume were all strong. The restaurant level margins came in at 22.5%, up 200 basis points year on year. And what's changing is they added steak to the menu and they have added protein, and it's bringing in a lot of men on the weekends and helping drive traffic, which over time will drive into weekday traffic as men realize this isn't just a salad chain. What's interesting about Sweet Greens is they're adding this, what they call the infinite kitchen, where they're adding robotics to their line, allowing for quicker, more precise, and cheaper labor. And so when you look at it, they raised guidance. The second half of the year guidance looks very conservative, and their store growth will accelerate over the next 3 years. This year's not that exciting, 13%. Then it's going to 15%, then 20%. So a lot of elements of Sweet Greens remind me of Chipotle like 15 years ago, where they had these big, very productive stores in urban locations. They start to roll it out. And now we're seeing Sweet Greens, like the new locations, are having better margins than the existing stores. And so everything's kind of clicking at Sweet Greens. The stock is really expensive. The numbers look low. And I bought a little position. I'm going to do some more work on it, but it's really impressive what they're doing.
Okay, and you also wanted to do an update here on your favorite Hims.
Yeah, so Hims reported last week, and the stock has come down on a beat and raise quarter. And the bulls, people are like, oh, what's going on? Why is it down? And going into the quarter, there was so much anticipation. This was going to be a huge beneficiary of GLP-1s, right? They've started to offer compounded semaglutide, right? They're doing their own form of the Novo Nordisk weight loss drugs. Because of the shortage, they are allowed to manufacture their drugs. Now, my thesis on Hims is that Hims is growing way faster than the category, and this company is about ready to hit a big wall, and they're not going to be able to grow anymore because the category is growing like 0 to 5%. They're growing a much higher rate, and they desperately need new products in order to keep this growth going. So when the quarter came out, the GLP-1 contribution was pretty small. They didn't quantify it exactly, but it's somewhere about 10 to 15 million bucks. And that's just not enough to get people excited. But more importantly, as Lilly on their call came out and said that they're talking to regulators about what's going on. The FDA has put out safety alerts saying that they're concerned about patient safety. I mean, doing compounded orals, they're not that worried about the risk of that, but doing injectable drugs where people are getting their doses off because they added 0 to the dose and they're putting themselves in the hospital is just not safe. And Lilly points out that, listen, this shortage is due to the fact we're trying to bring up manufacturing in line with GMP, state-of-the-art quality in manufacturing. The solution is not to turn to compounders who are totally unregulated and have them go hog wild supplying a product that we don't know what's in it, We don't know what the doses are and have people self-injecting it. So I think the FDA is probably going to rule on this and crack down on it pretty soon. That's coming clear through through their tone. But more importantly, when we look at the numbers on HIMSS, the gross margins came down sequentially. The new customer acquisition cost rose sequentially. The net new customers fell sequentially. And if we back the GLP-1 numbers out, the numbers are going to look even worse, right? So there's all these challenges boiling up. And I think everyone talks about, oh, this is a subscriber model, like it's some SaaS thing. Well, people haven't gone on and tried to play around with this site. You go in, you try to buy an erectile dysfunction drug for them. You can only buy it as a subscription. So these metrics that say, oh, look, we have all these recurring customers. It's like, no, you people sign up as a subscription, then go in and try to cancel. Coming back from Annapolis, I was on this website and playing around with what they were doing. And you try to order something and they say you can cancel on the website. Then you go back later and you can't cancel on the website. You have to call and get in line. It's like trying to cancel your cable bill. They have all these, you look at their terms and conditions, and they say, we're going to ship your second order 10 days early so you don't miss a dose. And so people are signing up for these things with the intent to cancel. We've looked at cancellation rates, and over 80% of our customers are gone after a year. And so I think that people who are saying this is customized medication, all they're doing is taking a couple compound ingredients, sticking them together. And I think this company is going to hit a growth wall in the next year, whether it's next. I think it's super interesting.
Super. Thanks, Russell. We need to move on. Mr. Meeks, what you got?
So today's Consumer Day, so I'll give you my tilt in the tech sector, starting with the OTAs. Now, Robert also has thoughts here. He's communicated them. These are the online travel agencies. And for the longest time on the Meeks buy list has been Booking.com. I prefer it over Expedia for a couple of reasons. I've articulated those here. Also, Airbnb is in the mix. But one of the nice things I like about Booking is that their CEO, Glenn Fogel, is a straight shooter. And when things are bad, he communicates things are bad, doesn't sugarcoat it. And I followed their quarterly call recently. And, they're really advertising, which is no surprise to anybody on this call, that they're seeing softness in hotel room bookings, which for this particular company is their driver. And that's a good driver typically because it's higher profit margin business mix. And so I stepped off the curb when I heard that, because that bodes ill for everyone in this space. And of course, that's consumer related, Herb. But the next is, the consumer electronic stocks. And of course, the consumer electronic stock that everybody likes to talk about is Apple. And I am not of the belief, I've also shared it here, particularly with the consumer starting to weakening with their spending, that when you put AI features on the next gen iPhone that should be shipping in size at Christmas, will it lead to what the bulls on the street call, quote unquote, the mother of all iPhone upgrade cycles? I think not. I hope I'm wrong. I actually hold the stock because if you're a tech investor like me and you don't own any, that's a risk in and of itself, but I haven't bought it fresh in a while. I think things just became a little bit more complex for them with the slowdown in consumer spending. And the last, and I know Russell has thoughts on this, is everybody knows that I have played the AI infrastructure trade. And one of the things that I've done is I focused on the data server companies. We've talked about Supermicro here, talked about Dell, talked about HP Enterprises. And one of the things that you saw, and SMCI, we can debate that. I think we should. But one of the things that we saw is when they break out their results, they've seen a significant weakness in their traditional servers, not their AI centric servers. And so that bodes ill, and as everybody knows, for not just consumer spending, but also enterprise spending. And so, a traditional of the kind of old school consumer electronics looks pretty bad.
All righty. Going to move on real quickly here to Mr. Morrison.
Sorry, Herb, I got nothing consumer for you, but I do have
That's okay. You don't need consumer. You have something else. You've got a situation where you've been stalking a stock and now you're buying that stock. What takes you from one to the other? What was the motivating factor?
Two things, Herb. They missed a quarter, which lowered the
What's
earnings.
the company? What's the company?
Well, you have to wait till the end for that, Herb. The company is called Chart Industries, and the ticker has nothing to do with a chart, or it's GTLS, and that stands for gas to liquids. They take gas. They're famous for LNG liquefaction technology and cryogenics. And so it's an industrial company that makes specialty tanks that handle all kinds of gas and liquid molecules. It's benefiting from the boom in LNG, but also from reindustrialization here and building factories, because a lot of their IP is used in process technologies, from foods to semiconductors to hydrogen, clean energy. So it's a good little $4 billion market cap industrial. They do have a twist, and this is getting kind of interesting. If you could chill ambient natural gas to 260 degrees negative Fahrenheit, you could keep a data center at 68 degrees. So they're turning their chiller system and refrigeration systems towards the data centers, and they have industrial fans, they have chillers, they have blowers, which is another fancy word for fans. So they're going to go out, and they just got a $40 million order from a hyperscaler to put in industrial blowers, not even chillers yet. So they think they could turn the data center business into $1 billion annual TAM because of their expertise in refrigeration.
Do you think they can? Because they've got competition in there. We have Larry Peck was on here talking about AAON, I believe, which is doing something similar.
Sure, there's a lot of money to be made there. So companies are tweaking their technology to fit that market. But they did get a $40 million order, which is their first order in history for a major data center. So that could turn out, it's only a $5 billion company. And if they can get $500 million a year out of data centers in 2 or 3 years, that would be a huge win for them. Right. So the stock, why did I buy it? The stock's traded between $100 and $200 a share for about the last 4 or 5 years. It had hit $200 a couple of years ago, $220 to be exact. It dropped down to $130, where I put it on my watch list. And today at $108, I bought my first stock.
It's a starter position, right?
A starter position, yes. And I was going to buy it around $100, and I consider it 107, 108 is almost rounding down to 100. And the other companies in its industries are holding up much better because they did miss. They did do a very aggressive deal. They bought a company called Howden. It gave them global exposure, and it gave them a big MRO business, the maintenance, repair, and overhaul. And that's a very good business for industrial companies because you always selling spares.
Yeah, I hear you on that. I just want to move on real quickly here to Charlie. KeyCorp is doing some strange things. They've got an investment. What is it? Another bank. How often does that happen, Charlie? Tell me what's going on.
Well, the big bogeyman for the banking industry this cycle has been interest rate risk. And so we've seen the failures of Silicon Valley and First Republic and Signature, et cetera. And that interest rate risk has not gone away. There are big holes in a lot of regional banks' balance sheets from underwater bond portfolios. And I'm expecting what you saw out of KeyCorp to happen again and again and again. There will be variations on the theme. For example, Truist sold their insurance company and used those proceeds to restructure their bond portfolio. PNC sold their big stake in Visa and restructured their bond portfolio. US Bancorp did a debt for equity swap. So there are going to be variations on the theme. But right now, you have a window of opportunity for this to occur because these regional bank stocks have run up 40, 50% off of their October, November lows of last year. So their stock prices are a good place to issue equity. And that's what KeyCorp took advantage of. And the rate structure has come down 100 basis points across the curve. So you have lower losses in these bond portfolios, but you still have significant losses. So this is the time to do it. And I expect you're going to find more banks doing what KeyCorp did. Okay.
And then in terms of this other issue they did, where they're repositioning, what is it? They're repositioning some of their portfolio.
Yeah, so what they're doing is they're taking their low-yielding securities and selling those off at a loss. But that creates a capital hole when you create that loss. So they need an outside party to come in and recapitalize them. And that's what Scotiabank did for KeyCorp. They took a 15% interest in KeyCorp by selling them. KeyCorp sold them 163 million shares. So there's a dilutive aspect to this up front, and then the payback is over time as you grow your net interest income, your NII. What is interesting is the marketplace seems to be following the playbook of 1994 and 1995, the last time banks got caught with huge interest rate risk. The difference is threefold. One is in 94, when rates rose and the banks were caught with huge unrealized losses, the stocks sold off 30 to 50% going into the announcement of these restructurings and recapitalizations. So they came out of the end of 94 and had a 50% plus rally in 95. And that's very different. Today, what you're seeing is these regional bank stocks are up 30 to 50% from those November lows. And so they're not having as robust a after effect on these announcements. In fact, I think it's very important to point out KeyCorp, which opened up 15 to 20% yesterday at the opening, closed only up 9% and is down again today. And yesterday's close was still below the July high when all these things rallied around the soft CPI number. So you're not getting the same oomph coming out of this. The second thing is the NII benefit is proving to be low single digits, which is not something to get too excited about. And the third and most important thing is in 94, we were coming off of a horrible credit cycle in 90, 91, where there are a lot of failures. Today, we haven't had a credit cycle, and I think that's ahead of us. So the question is, will these restructurings create some short-term, support for these stocks? I think it will, but will they be overwhelmed by the credit cycle next year?
Okay.
Hey, Charlie, question for you, sort of related, but on Home Depot and what's the read through to the home builders? Obviously negative.
Yeah, my thesis is you've got a deflating asset in housing, and that's going to create a negative wealth effect for the consumer. And so you're not going to invest in a deflating asset. And I think that's one of the problems that a Home Depot faces. And it's one of the problems that the home builders are going to face if they can't get these homes sold at current prices. Their gross margins are going to get squeezed. We saw a little bit of that in the second quarter by some of the home builders, but they talked it away as if it's only temporary. And I don't think it's going to be temporary. I think you've got a long-term 18-month bear market in housing and housing-related stocks. So whether it's Beacon Roofing or Owens Corning or Mohawk or Masco or the home builders, I think they're all going to be under pressure for the next 18 months. I point out on this thesis of the regional banks that need to recapitalize their balance sheets and restructure their bond portfolios, there are a couple of names that stick out that really need to do this. And not everyone's going to be able to do this because you need an outside party to come in and provide that capital. And there are a couple of names I want to highlight. Comerica is one, symbol CMA. Synovus is another, SNV. Zion's, ZION. Of the mid-tier regional banks, they face a need to recapitalize and get rid of these underwater bond portfolios. And then in the larger cap banks, Ally Financial, which is a non-bank auto finance company, needs to do this as well because they're facing a situation where car sales are slowing, and I think margins are going to get squeezed there. So I think Ally Financial is an interesting one that needs to recapitalize and may not be able to find the capital to do so.
Okay. And hey, Steve, before we get out of here, I know you had a question for Marcin.
Yeah, I was just looking at the chart on Chart Industries, and holy cow, what took this thing from 170 to 108 in a week? Was that just the market melting down on Monday?
That was
Has to be something more than that.
Well, they did this very expensive deal, and in order to placate Wall Street, in my humble opinion, they set very aggressive goals for the combined business, and they just basically fessed up last quarter that was full of poop. So they dramatically reduced earnings, like 20%. Now, with the stock plunging more, it's down to 6.5 times EBITDA and 8 times next year's earnings, even though the balance sheet's pretty levered. So I'm not a fan of deep cyclicals in this environment. These guys have a good backlog, so they'll make it through any kind of slowdown. If they'll need to replace the orders then, but they really had a major reset with earnings expectations, and they're still guiding to 15% revenue growth for 3 years compounded. So it's still an impressive growth story which is what I like to do. I like to buy stocks that get killed to unsustainably low valuations on negative estimate revisions, but still decent growth. This fits my buy formula to a T.
So what are you looking for to keep adding? You got a starter position on here? Are you waiting for the next quarter to see that they're in fact doing what they said they were going to do?
Goes down 5 or 10%, I'll double the starter position, and then if it goes down a little more, I'll buy a little more. As long as they don't, destroy the earnings estimate for fiscal 25, and the macro would have to kind of roll over or crash for that to happen. That hasn't happened in the industrial. What's happening in the consumer is not happening to businesses yet because they still have very decent profit margins and are investing in capital equipment here in the U.S. A lot of it subsidized.
Hey, Meeks, you know what? I have a feeling you're writing this stuff down and you're putting it on your list. What's going on with you? You had a question here.
Yeah, like I'm a CIA agent over here with all these good ideas. I just wanted to follow on technology and the consumer. I'd be remiss if I didn't mention Amazon, another stock that I'm staying away from. I was very pleased with their Amazon Web Services business, which grew 19%. So they're still losing share to Google Cloud and Microsoft Azure, but it was better than the analysts expected. But the point about the consumer, pretty, I don't want to say dire outlook, but I'm a little bit worried about the outlook for e-commerce. And so in that space, I go to Mercado Libre, South America, in Uruguay, where they just put up in their e-commerce business a 30% growth rate. And they also have an attractive payments business, which is highly profitable. I could not live alone without the e-commerce.
Paul, circling back on SMCI, did I hear you right in saying that you're staying away from this? You're cautious on this now?
So what I worry about is I bought some, Steve, I did press at 517 since the last I saw you.
Me too.
Just a small bit. And remember when you pressed me on it before their quarter a couple weeks ago, so I was a little squeamish, but then I said, if you're going to do it, keep it small, right? So I worry the most with SMCI that, yes, are they giving away the store to the hyperscalers on price for AI servers? I think there is going to be continued pressure. They've already seen that. And also, they're going to have to probably, with this voracious demand, which may be a good thing with their sales volumes for working capital, they're going to have to do some kind of financing. I hope they can lever their balance sheet instead of issuing equity. So I'm watching it. We've had 2 days in a row of a nice bounce in not just SMCI, but those kind of NVIDIA-related names. We'll see if it sticks. I don't believe it yet. They are having a number of sell-side meetings, and Russell was pretty clever. Noticed that they were one-on-ones instead of big room meetings. But I would say, coming back on that, if I really was scared about meeting analysts, I don't have to have a one-on-one. I can just not go to the conference.
All right, everybody.
I'm kind of mixed on that read. But yeah, I'm waiting for it to stabilize, and I'm grateful for what's happened the last 48 hours, Steve, but doesn't make a trend yet. I'm waiting to see more confidence that fundamentals lies, the chart is stabilized.
Okay. Well, thanks, everybody. This was great. That is it for today. Thanks for joining us on the Roundtable. I'm Herb Greenberg, and we will see you tomorrow.